Hey, Mortgage Coach community, Dave Savage here, and today with me I have the one and only Mitch Kiter. What's up, Mitch Kiter?
Doing well. How you doing, Dave? Happy New
I'm
Year.
good. Happy New Year to you too. So, for those of you that don't know Mitch Kiter, he is the top attorney, compliance attorney in the mortgage space. I've interviewed Mitch more times than I can remember. I'm going to put a few links below to some of the most watched interviews I've done with Mitch. I'm also going to put back when Trade was coming out, we did a lot of talk, and I'll put a few links. So if you want to know more about Mitch and some of the commonly asked questions he's answered, we'll have links to that. So Mitch, it's a new year, a lot of changes in the mortgage space. The one that I've been hearing a lot of loan officers and executives ask me about is HMDA changes and how they're going to impact loan officers. So what are your thoughts on that?
So, Dave, a lot of people are focused on, the detailed changes of HMDA, the fact that there are so many more data points and data fields and things of that sort. And we can talk a little bit about that. But really, the biggest change for loan officers is it puts them in the spotlight. From now on, loan officers, in terms of what is known about them, exponentially greater amounts will be known about them, because the loan officer's unique identifier, their NMLS identifier, is going to be part of what's reported to HMDA. So everything you know about the company, all 48 new data points and 110 new data fields, those that apply to the loan officer in terms of the manner in which he originated that loan or she originated that particular loan are going to be out there for a regulator to see. And that's critical. That's critical for a loan officer to know and understand, because when the data points went from 23 to 48 and the data fields went from 39 to 110, all of those points together paint a picture, not just of how a lender is doing from a fair lending perspective and an origination perspective, but now, since each loan that the loan officer is responsible for having originated now has their unique identifier along with it, it's going to paint a picture and it's going to tell a story about how that loan officer is originating loans. And that is, that's really important stuff for loan officers to understand. Everything they do, their lending patterns are now just going to be in an open book for everyone to see and to analyze. Now, when I say for everyone to see, I'm talking about regulators, because the CFPB's proposal as to what not to make public includes not making public the loan officer's identifier. And the reason they are proposing not to make that public is because they think that people will then be able to figure out who the borrower is, who the consumer is, and then they'll be able to get some personally identifiable information that would create privacy concerns. But in terms of what regulators will see, they'll know exactly what you've been doing with your lending, which includes how you've been pricing your loans. And, loan officers are already putting on, on their advertisements, their unique NMLS identifier as well. So when you look at the entire picture, okay, you're being watched. Big Brother sees you now, and you are in the spotlight. And that's the most important thing for loan officers to know and understand.
So just new level of personal accountability as a mortgage professional to do it right. And I've always advocated that your perfect loan process is not only a sales advantage for you, it's a compliance advantage. And if you really take that seriously, being good at compliance makes you better at sales, because you're delivering every family the best possible experience. So that's great.
You and I are on the same page. We're on the exact same page when it comes to that. If you do it right, that is great for your sales as well. If you're compliant, you're going to do much better out there. That's correct.
Absolutely. And by the way, mortgage coach professionals, that means every family gets a total cost analysis. You don't pick and choose the family that is rate shopping you and demanding to get an informed decision. You give them one experience, and the family that barely qualifies is just happy to hear that they qualify for a home gets a different point of sale experience. That's not compliant. So, and it's not good sales either. Everybody gets the best total cost analysis experience.
And that will lead to fair lending action, no doubt. So you're absolutely correct. If you're going to do it, you got to do it consistently across the board for everyone and not pick and choose or cherry pick. I agree with that.
Right on. So, when I threw it out there, I'm interviewing Mitch Keiner. I mean, lots of questions. I don't think there was a couple common trends, but one of the most populars was new CFPB leadership. What does that mean to our industry? What does that mean to loan officers? Thoughts?
Well, it means a lot. Cordray's gone, and it's a good thing that Cordray's gone because he pushed his individual, very political agenda and, almost destroyed the CFPB, if you ask me, by pushing that agenda. So any change would have been a good change. The change that's taking place right now has some good and some bad that's associated with it. I mean, the good news for loan officers and for lenders in general is that there's going to be an easing of enforcement. That doesn't mean that there isn't going to be any enforcement. It means there's going to be an easing off on enforcement itself and hopefully more guidance as opposed to, and warning letters, as opposed to just throwing the book at someone and trying to basically put them out of business. I think there's going to be an easing off on regulations as well. Now, all of that is obviously good for this industry. I think it's going to promote this industry and enable you to go out there and compete in the fair market effectively. But there's bad that goes along with it as well, and that is, a lot of people, loan officers and others, seem to think that with this new CFPB 2.0, regulations are completely out the door, enforcement's completely out the door, and no one otherwise is going to be watching them. And I tell you, if you think that way, you're waiting for a catastrophe to happen. You cannot think along those particular lines. The bad that comes out of those thoughts are, we've had an unlevel playing field between those who comply and those who think, well, enforcement's been somewhat sporadic and I can get away with things. And so maybe I'll do some things by way of LO comp or by way of RESPA, by way of TILA, that, maybe on the edge or may have, gone over the edge itself, but I'll take my chances and I'll win more customers along those lines. And you're going to see more and more of that now. The dichotomy between those who want to get it right and those who don't care because they think that enforcement isn't going to be there. And I'm here to tell you, enforcement will be there. They will look at egregious instances. They will look at what's going on, what you yourself are doing. And as I said, they're going to have a lot more information available to them through HMDA and through other means as well. So again, the good news is it's going to be a little different. There's going to be an easing off, which was much needed, absolutely. But the bad news is some people are going to take more advantage of that than they should and think, all right, now we can just forget about these rules and regulations and move on and do what we want. And that is something that you should not be doing.
Right on. So what about, let's zero in on RESPA a little bit, because I think that's something that's near and dear to the mortgage coach community's heart. And there's been a lot of talk that there's going to be an enforcement holiday, whatever that means. What are your thoughts on RESPA enforcement under the new CFPB leadership?
So first of all, let's start with this. RESPA is a 43-year-old statute. There have been 8 different presidential administrations that RESPA has lived through and survived. And in each one of those administrations, there has been RESPA enforcement. There will continue to be RESPA enforcement. Hopefully, when the PHH decision comes out, when our case comes out, the manner in which the CFPB under Cordray had interpreted Section 8 of RESPA, and specifically HC2, which they said basically didn't exist, that will go away. That will be thrown out, and we'll go back to a reasonable interpretation of RESPA. No one will give Section 8 of RESPA. No one will give, no one will receive a thing of value in exchange for a referral itself. But you can still do business with your referral partners. As long as it's real business, it's necessary business, and the payment is fair market value. That's how RESPA had been interpreted for 40 years. That's how RESPA will be interpreted on a go-forward basis. Now, in terms of an enforcement moratorium or something else along those lines, so when Mick Mulvaney came in as the interim director, he put enforcement matters as well as regulations on hold for only, a 60-day period of time. That's fine. That doesn't mean that there isn't going to be any enforcement. The other thing that you've got to recognize about RESPA is that there are so many different regulatory bodies that can enforce it. So for those of you that are not with banks, state banking authorities have authority over Section 8 of RESPA. State AGs, for those of you that are with banks and with independent mortgage bankers, state AGs have authority under Section 8 of RESPA. And in fact, 18 AGs signed an amicus brief against PHH in our case, in my case. And so you know what their position is on RESPA. And they also signed a letter saying effectively that they would be the new CFPB, because they thought that in a Trump administration, it would not be enforced. And I can tell you, those guys are active. I spend a lot of time every week talking to AGs, negotiating with AGs now, and doing things along those particular lines. Insurance commissioners have authority, state insurance commissioners have authority to enforce Section 8 of RESPA. So while you may see an easing on the part of the CFPB, and I probably shouldn't say may see, I think you will see an easing off on the part of the CFPB. Number one, they're still going to go after those egregious examples. They always have, regulators always have, and they will. And number two, you still have all of these other regulators to deal with. So be careful, okay? Don't get yourself caught in a kickback scheme, and in fact, stay away from any type of a kickback scheme. Earn your business the old-fashioned way. Earn it by working hard and winning over your referral sources.
I love that. And delivering your best experience, whether it's a realtor experience, whether it's a buyer experience, deliver your best experience to every family. Don't pick and choose who you need to give your best experience to. Give everybody your perfect experience. I mean, I've interviewed the best loan officers in the country, and that they all have that in common. They have consistent experiences that are high end. You were going to say something, Mitch?
I love that you keep coming back to that, because consistency is absolutely critical. Absolutely critical. You have to treat everyone the same. You have to give them the same opportunities. You have to use the same tools, the same mechanisms consistently across the board. There's no way that you can justify to a court, okay, not doing that. And there's significant liability if, in fact, you're treating consumers differently, one from another.
Love it. So we'll do one more question, which, by the way, has been the most asked question when I threw it out there. But I want to remind everybody, this is going to be a conversation. Mitch has agreed to come into the Mortgage Coach community and provide us with answers to the questions that we have. So if you're getting value from this, you're watching it on YouTube, like it, let us know that this is valuable to you, and share it. If you're a branch manager, share this with your team. If you're a regional leader, share it with your region. And obviously, if you're head of production, get this out to your sales force. Our goal is to give the Mortgage Coach community and the loan officers that are in our community a distinct advantage. And again, compliance is important to your survival. I think compliance is important to your success, because if you just live within that sandbox of consistency, treating people fairly, like Mitch said, do business the good old-fashioned way, just work hard, you're going to kill it. So Mitch, here's the last question for today's conversation, and then let's wrap it up together. But any updates or advice when it comes to co-marketing agreements with realtors? Everybody wants to know, is there anything new, and what leadership do you have January 2018?
So here's the deal about co-marketing. There has been no guidance that's been given under the new CFPB, as I like to refer to it. Nothing has changed along those particular lines. You still have to be careful for all the reasons that I just talked about when I spoke about RESPA enforcement. You need to be very careful about how you handle co-marketing with realtors and other third-party settlement services. First of all, number one, pay your fair share and make sure your other party pays their fair share as well. The proportionate amount of the ad, that's what you pay for. If in fact you think, well, it's easy for me to in fact print up flyers and do things like that, and I don't have to charge the realtor, absolutely not. Absolutely not. You have to come up with a formula to come up with what your proportionate share is and what their proportionate share is as well. Second, if you're dealing with a third-party provider, such as a third-party website provider or someone else, have your own relationship with them. Don't just come in because the realtor brings you in and then defray the realtor's costs by paying the realtor a percentage of that particular ad. Sign an agreement with the third-party provider yourself, pay them directly, and make sure you do it. Third, mark your space as an advertisement. I can assure you, you're not going to lose any business as a result of that. But put that little word above it that says advertisement or paid advertisement or something else. And the reason for that is when you co-market with a realtor, the CFPB and other regulators believe that by virtue of the fact that the realtor is there with you, that the realtor is endorsing you. And an endorsement is a referral itself. But if the consumer understands that this really is co-marketing, that this really is an advertisement on your part, then you undercut that argument. That is in no way, shape, or form an endorsement. You're paying to be there on that spot. It's a little thing that you can do. It's pretty simple. I have the lenders that I represent doing that. I advise everyone to do that, quite frankly, and it'll keep you out of a lot of trouble.
All right, so this has been fantastic. So Mitch, let's wrap a bow around this. You know, it's January 2018, and everybody on this call listening to this, you need to do well this quarter. Right now, you need to, what strategies can you do to close more loans now? And you need to prepare yourself for 2020. I interviewed Steve Brown. He was formerly the chief futurist for Intel. By the way, I'm gonna put a link to that below. So I just did a 30-minute interview with him this week. And he was painting this picture. It's kind of funny, like you're from a compliance standpoint, everything you're saying will make a loan officer more successful. And he's telling us where the puck's going to be in 2020. And if you are a referral-based local loan officer, you need to use your CRM like never before. Big data is coming, artificial intelligence is coming. You need to use your CRM so that you're building data and you're building relationships. You need to deliver an amazing experience to the family so that you're distinguishedly better than, internet lenders, banks, get total cost analysis. You need to do annual reviews with your client so that, who's going to be the successful referral-based local loan officer in the future? That person that uses technology to be compliant, to be successful, and to have more human contact, to be able to use video so that, that's Dave. Dave's my loan officer. So hopefully you're hearing from Mitch, compliance is important. Highly recommend down below, there'll be a link to this interview with Steve Brown saying that, hey, if you want to be relevant and successful in 2020, you need to do all of this stuff now. Mitch, any parting words as we wrap up today's call, and anything you want to say to get more questions for the next time we do it?
Well, first of all, I completely agree with everything that you just said. Second, you know that in time, rates are going to go up. They've gone up a little bit lately. They're going to continue to go up. Refis are going to go down. So your referral sources, your relationships with them are going to be very, very important. And because they're that important, because the purchase mortgage is becoming that much more important, because that's where the business is going to be in the immediate, short-term, and medium-term future itself, you're going to be under a lot of scrutiny. Believe me, I've spoken to a lot of realtors, real estate brokerage companies, and other settlement service providers that get involved in co-marketing, that get involved in doing things with loan officers and with lenders. They want to get it right as well. It's important to notice that. Don't just go into it thinking, well, I have to do this or I have to do that. I can assure you, they understand the consequences themselves as well. And so get it right, and you're going to have a good future.
Yeah, and I just thought, so I'll put a link below. I wrote a LinkedIn article last week saying that annual reviews should be your number one priority in making a case for that, because it really does help you distinguish yourself and create that customer for life relationship, which serves your realtors. By the way, the kind of annual reviews that I advocate aren't just to get refis, they're to get purchases so you can close more business. So, hey, Mitch, thanks for making time for the community. Appreciate it. If you have questions for Mitch, put them below. I'll post this on Facebook. We'll have it on LinkedIn, and we will collect more questions, and we'll bring Mitch back sometime in February. Thanks again, Mitch.
Sounds good. Thank you, Dave.
Hey, real quick, Mitch, for any leaders, executives that want to follow you or contact you, what's the best way to follow you and keep in touch?
Well, I'll give you 2 ways. In fact, you can follow me on Twitter at Mitch Kiter. You can follow me on LinkedIn. You can also email me, kiter@thewbskfirm.com, and you can give me a call. I'll give you my number, 202-557-3511. Any of those ways work for me. I look forward to hearing from you.
All right. Take care, everybody. Have an awesome day.